syndication is a sophisticated structure that people use to acquire apartment buildings and other real estate, right? Wall Street created the structure, and Wall Street does one thing really, really well. They raise a whole lot of money and they deploy it very efficiently. So what syndication allows people to do is to have a deal, have an opportunity, and efficiently raise a large amount of capital from passive investors. So a lot of people listening right now, they might be familiar with joint ventures, right? You buy a duplex, you have somebody sign on the loan, they'll provide the capital, somebody, they get their hands dirty. The challenge with that is when you try to raise large amounts of capital, you have far too many people. So that joint venture type of structure doesn't work. It's not scalable. The other disadvantage is in a joint venture, everybody is deemed to be active. So their risk exposure is unlimited. So if you and I decided to do a triplex conversion, and even though you're bringing the money and I'm doing all the decision making, if something goes wrong, you're getting sued just as much as me. And your risk, like you could lose everything. That's just the nature of the business. What syndication does is it segments two components of the syndication, right? Like you've got the active party called the sponsor. So they make all the decisions. And there's something I call the real estate matrix, like the four components every deal needs, right? You have the deal itself, the opportunity, you have the financing, you have the equity, the capital, and then you have the management. The sponsor, the active party, brings three components of the matrix, right? They bring the deal, they bring the financing, and they bring the management, the hands-on experience. But they're missing the capital, the money. So what they do is, through the syndication structure, they're able to raise a large amount of money from a number of different individuals. And those individuals are afforded protections under the law because of the way it's structured. So their risk is limited rather than unlimited. So that's why it's called a limited partnership. If you're a doctor, business owner, programmer, a high income person, there's no why would you expose yourself to unlimited risk when you can use a structure that limits your risk and still affords you all the benefits of real estate ownership, right? So if somebody passively invests in a syndication, they're getting the tax benefits, they're getting the cash flow, they're getting all the appreciation that comes along with owning real estate, but they don't have to be active in the deal. It's a fantastic structure. Whether you're on the active side, doing the deals, raising the capital, or on the passive side, investing your money in a deal, it's a fantastic structure.
Okay, so is that what the limited is? Is it your money? So that's what, pretty much, if you lose, you just lose what you put in.
Correct, yeah.
Okay, exactly.
Yeah,
okay.
But your risk, because if you're investing as a limited partner, you're not a real estate expert. You're not making decisions, right? You're just bringing your capital to the deal. It's the general partner who is shouldering the burden of the risk.
Okay. And how many people can be in a limited?
Oh, it's unlimited. Wall Street uses that structure to raise billions and billions and billions of dollars. So you can syndicate a 40-unit apartment building. You can use it to acquire a 200-unit apartment building, 500, 1,000. You can raise 20 million, 10 million, 50 million. It's really a scalable structure, and it's very efficient with how it does it. And obviously, as you scale up in terms of your total raise, your investment minimum is going to change and all sorts of different things. But yeah, in a nutshell, it's a very efficient way to raise large amounts of capital.
Okay, so say someone right now, they have 40,000 or 50,000, right, and they want to invest in real estate, right? Is this something that they should look into, like in terms of syndication? So they would obviously see the deal, right? So they get treated like they see everything before they actually invest in, right? And then they put that in, and then you said they get the cash flow. But the cash flow, I guess, is a percentage of what the total amount is, right? Is that what it?
Correct, yeah. So when we're talking about syndications and real estate funds, we're really talking about securities. So there are a number of laws that we have to abide by. Here in Canada, securities are a provincial matter. In the US, you've got federal and then state level. So with a lot of securities, so syndications, we work in what's called the exempt market. And the exempt market is where you're limited to raising capital from what's called accredited investors. So the investor has to either meet an income threshold or an asset threshold. So income, it's 200,000 per year, or 300 as a couple, or assets, it's $1 million of net assets, not including your primary residence.
Okay.
So the reason is, you go back to the 30s. With securities, you have these traveling stockbrokers swindling people. People would invest their life savings, and then the person was never heard from again. There was a lot of fraud. So the government stepped in and said, hey, listen, like, if you're going to invest in a security through the exempt market, meaning that you don't have to file a prospectus and all that stuff, the person who's able to invest in these opportunities needs to have the resources to absorb a loss in case they lose, and they need to have expert advice. So somebody earning $200,000 or $300,000 a year will be able to afford an accountant. They'll have a lawyer. They'll be able to talk with these people. Somebody who's only worth $10,000, they don't have the resources, right? So it seems arbitrary because, let's face it, I know people who know real estate inside and out who don't meet the accredited investor criteria. And then I know people who do meet the accredited investor criteria who have no business investing in real estate. It's just an arbitrary line the government made, and that's the rules we have to play in. So if somebody's looking to invest in a syndication or a real estate fund, you're really investing in a security. So you have to make sure that the sponsor, the person running it, has to make sure they're compliant. In the U.S., the rules are slightly different with who can participate. We won't get into that today, but yeah. So if you're looking at a syndication or real estate fund, you want to speak with a securities attorney and just make sure you're compliant.